Good morning, everybody, and welcome to the last webinar this year from the IMAP webinar series. Today, we're really going to be talking about one of the fundamental structural issues which every investor will be thinking about, and that's the role that Asia, Asian economies, Asian markets, Asian investments play in the construction of global portfolios. And we're lucky enough to be joined today by the Chief Investment Officer from Lonsec Investment Solutions, Nathan Lim, to moderate our session today. And we're going to be joined by two presenters, Chad Hitzeman from Global X ETFs and Monik Kotecha from Insync Funds Management, who come to us with a global perspective as a way of thinking about the Asian opportunities and the issues that Asia both creates and makes available to investors. Before I hand over to Nathan for what I know is a fascinating discussion on the issues that Asia creates for investors, let me just say a little about the upcoming events for us in the first part of 2025. Our first major event, and I'm really excited about this, is a roundtable which we're going to be hosting with AMP, where we'll have the chief economist from the RBA, Sarah Hunter, joining us to talk about interest rates, the interest rate environment. So this is ahead of the first RBA meeting for the year. So while I don't anticipate she'll be going, well, I think on the one hand it could be, and on the what I do think we'll get is the perspective at the topmost level of the RBA on the issues that they are thinking about as we head into what ought to be a rate reducing regime in an election year. On the 26th of February, we'll be joined by the winners of the 2024 IMAP Managed Account Awards as we talk about what it really does take to run an excellent managed account program in their asset class for licensees, for boutiques, in the responsible investing area or in innovation. And we'll be using that event live in Sydney to introduce the 2025 awards. Deanne Baker from Lonsec will be joining our awards judging panel this year, which I'm absolutely delighted about. It's a judging panel made up of some of Australia's most experienced portfolio managers who set their own interests to one side to try and identify the best of the best in the asset classes and in portfolio construction for advice organisations. Then also in February, we'll be hosting a webinar series with the FAAA. So those of you who were at the FAAA Congress last week will have seen that for the 6th or 7th year in a row, IMAP hosted the Managed Account Zone at the FAAA Congress. I think we are, in fact, the largest exhibitor or participant at the FAAA Congress each year. This year, we had 10 of Australia's leading managed account providers join us on the Managed Account Zone. And we'll be inviting those 10 to participate in our webinar series in February over a series of 3 weeks, 3 Tuesdays, to talk about what it takes to develop a successful managed account program, what it takes to manage the investment components in that managed account program, and what it takes on an ongoing basis to ensure that that program remains successful for both advice organisations, but more importantly, for clients. And then in March, we'll be hosting our portfolio management conference in Sydney and Melbourne, where we have an opportunity at what I think will be a fascinating time to review the state of investment markets. So I look forward to you being able to join us at any of these events, both live or virtually. I don't need to tell you how to ask a question, but we do, of course, encourage your questions as we go through. The panelists will be able to see them. So now it's my pleasure to hand over to Nathan Lim to take us away. Nathan, thanks very much.
Thanks, Toby, and thanks everyone for joining us today. Just to let you know, Monik, Chad, and I, we've been catching up over the last couple of weeks, getting ready for the session, and we've decided to actually hijack the topic slightly. When we were talking about how we wanted to present this, we realized that Asia was probably far too narrow of a lens to be considering this, and that really it should really be a broader discussion that encompasses emerging markets as well. And so we hope, if you guys don't mind today, who are on the line, that yes, we're going to cover off on China, we're going to touch on India, but we are going to sort of bring in that broader lens of what's really going on in EM. And so what I'm going to do first is the three of us are each going to now take our turn and just sort of bring a broad lens to how we're going to speak to what we sort of bring to the table today in today's discussion. I'm going to start with a very large sort of macro sort of perspective, in a sense that I'm going to talk about Lonsec strategic asset allocation and where do we put Asia and specifically EM within that portfolio. So for those of you that follow Lonsec, you would have seen that last month we've actually released our SAA update for 2024. A couple of key changes, of course, was that we've released a new taxonomy where we have introduced new asset classes, and just as a strange coincidence, we actually, for the first time, have actually broken out emerging markets as a specific asset class, as well as Aussie and global small caps. Now, one of the key things that made this development possible was that I just want to call out that chart on the right, was that we came to the realization as we were doing our SAA review that markets that were traditionally sort of viewed as being either frontier or too risky is probably very much backwards looking. And we're going to hear a little bit about that from Monik as well in his comments today. And that volatility chart in the top right-hand corner there, you can really see that things have changed dramatically from 20 years ago, when volatility in emerging markets really was off the scale. And you could see quite distinctively that those markets were more risky. But in more recent decade, that difference has kind of disappeared. And I think that was probably the first big insight for us when we started thinking about portfolio construction, is that perhaps we really need to open up that lens and consider other markets. And that's where EM comes into play. And if we can flip to the next slide, what we can show here is this is how it sort of manifests in our current SAA framework, but then applying that DEA or dynamic asset allocation framework on top of the dynamic asset allocation overlay on top of it. And all I want to call out here is that EM line within our growth allocation. First of all, neutral, just for those of you guys who are trying to get a sense of sizing, within Lonsec's SAA, neutral for a balanced portfolio is a 5% weight to EM, going up to 7.5% for growth, and then 10% in high growth. Anything below a balanced allocation for us is actually a 0. So hopefully that'll give you a bit of color on how we're thinking about sizing within EM. And then right now, just at a DEA level, we clearly have some concerns around China, and we are obviously aware of what's happening with President-elect Donald Trump's threats around tariffs. So until we get better clarity on that, just from Lonsec's point of view, for a DEA perspective, we are slightly underweight EM, largely on that uncertainty around China. So that's really what I hope to bring from today's presentation, is that sort of macro overview. With that, I'm going to pass it over now to Monik to sort of provide his perspective and what he brings to the table.
Thanks, Nathan, and welcome everybody. Toby, if you don't mind going to the next slide, please. So at Insync, I've our core belief, and this is an interesting chart, is that really over the long term, share prices follows the earnings growth of a company over the very long term. And this is obviously a chart of the US going back, and I think it's a similar story in Europe and in Asia, certainly from my experience, that there's a very high correlation between that. So you really, the key is actually finding those sustainable earnings growth businesses, and that's what ultimately delivers really decent shareholder returns. Next slide, please. So this basically two things, or two key aspects that we believe actually delivers these companies that can generate these sustainable earnings growth. One is really looking to identify structural trends. These are long-term trends, not themes. They're unstoppable, and clearly emerging markets has a critical role there. A lot of the future growth is going to come out of the emerging markets. Understanding that's important. So that's certainly one of the key trends that we're exposed to. But it's also not only just identifying trends, but it's finding those industry leaders that are highly profitable. So it's not simply just buying a trend and buying a bunch of companies exposed to those trends. We don't think that's the way to build a successful portfolio. It's really picking the eyes out of it. So if you go to the next slide, please, Toby. This was an interesting study, again, done in the US, because this has the richest history, but be very similar for other markets. And obviously on an annual basis, everyone's looking at the next trade in the next 6 months and next 12 months. What we all tell our clients, it's all about investing in the long term. And then everyone gets short term in terms of their perspective, and they start losing what it is that ultimately delivers performance long term. And this is a distribution of returns going back pretty close to 100 years in the US. And what it shows is that only around 3.4% of the entire market during that period has actually generated almost all the wealth, all the shareholder returns that's come out of the US. And that's really a fascinating insight. And again, that I think just bodes to the importance of picking stocks. It's really been quite critical when you're building a portfolio. If you go to the next slide, Toby, please. So these are the various trends that we're exposed to, the structural trends. So as I said, these are very long-term trends, unstoppable, like a giant wave that just keep on building and getting stronger over time. You can look at 5 or 10 years quite easily and conceive that these trends will be a lot larger. You can see it's quite diverse, mixture of tech and non-tech. But the key thing there is that the emerging middle class is really an important component of that. 60% of growth in the global economy by 2030 is going to come from the emerging markets, particularly Asia, but broadly emerging markets. So you just can't ignore it. You really need to understand it wherever you're investing money. Even if you're investing in Australian equities, you still need to have a good understanding of what's happening in Asia and emerging markets. And really, the emerging market consumer is an absolute powerhouse. 91 million extra consumers are going to come out of the emerging markets into the emerging middle class category. And close to 4 billion is the size that they're expecting by the year 2030. So that's pretty much close to half the global population. Half of that is got to be the emerging middle class coming out of Asia and Latin America. So just finishing off with the final slide, please. And this, I think, is just sort of looking at our own history of performance since inception on a rolling basis, so rolling 1, 2, 3, 4, and 5 years. And you can see there that if you have a very long-term perspective, the strategy actually does deliver very, very good returns. So with that, I'll pass it over back to you, Toby. Thank you.
Perfect. I'm Chad Hitzeman from Global X Exchange Traded Funds. Forgive me for not having my image appearing. I'm going to run through a speed round overview about how we focus on Asia. Now, I should mention we do have thematic-oriented ETFs that encompass Asia, but those exchange-traded funds of ours that have a specificity of focus to Asia exclusively are our emerging market ETF portfolio. So I'm going to speak a little bit more about those. Next slide, Toby, please. Thank you. A bit of biographical starting background for you, just to scene set. Global X, we're an exchange-traded fund provider. We have a plurality of solutions. For instance, we have liquid diversifiers for non-correlation. I mentioned thematics for basically amplifying the degree to which your portfolio is alpha-seeking. In this session, in particular, we're going to canvas Asia-oriented emerging markets with highlighted focus on India. And then we're going to also perhaps touch on a few other things. Next slide, Toby. We can go to the next slide. I'll leave that one there for anyone curious about our extended range. So this is interesting. This is going to be a good setup. So since 2011, emerging market investing has actually delivered dramatically stepped down cumulative returns of around 50% over that 14-year period versus the prior period. And, you know, in spite of that, we still think there are a few potential drivers going forward that we're watching, which may spur emerging market performance. And I wanted to quickly enumerate a few of these items. And I know in the prior discussions we have had, the panel here, and also my discussions I've had with clients, increasingly we are seeing an amplified need for tools to diversify away from what are increasingly considered concentrated developed market indexes. So those tend to be US-centric, so geographic concentration, as well as company-centric in terms of FANG. And so we're seeing clients on our side turn to, say, small cap, mid cap universes to alleviate some of those concentration concerns, valuation concerns. But on our side, equally, we think that emerging markets can prove to be another outlet into which you can diversify. You know, going forward, two factors, let me mention, that might serve to be tailwinds for emerging markets. If US interest rates continue to come down a bit, and they've come down circa 75 basis points so far, that could prove to be a stimulant to performance because EM equities are growth. And so if your net interest expense goes down in terms of interest rate cost, it should have a flow through and multiple expansion for EM. And interrelated to the interest rate story for emerging market equity performance going forward might be what happens to the US dollar. And so if the US dollar softens in its relative performance versus a broader basket, that too might prove to be a tailwind for emerging markets. Emerging markets tend to have USD denominated debt. And so that interplays with interest rates, and then also the US dollar interplays with those things. Historically, to put a statistic on this, usually when the DXY, which is a broad gauge of US dollar strength, falls by 1%, emerging market equities tend to rise by 3.5%. So that's just a little bit of background there. Next slide, Toby. And I think that the proposition we wanted to really hone in on here is that, and I know, Nathan, on your side, we've had conversations, and I've had conversations with other allocators. Usually I see when you have emerging market investing, at least through an index pathway, not necessarily an active manager, you tend to default to the broader, the better, supposedly broader, the better diversified indexes like MSCI emerging markets. I guess what we're trying to say is there's been issues with broader indexes like the MSCI EM index. And that is because there's a lot of concentration toward state-owned enterprises. And later in the discussion, I might be able to enumerate why there's deficiencies with companies that are state-owned, such as the fact that they might not necessarily be aligned to minority shareholder interest. So that's not necessarily a good thing. It's a pitfall to the broader index. And then lastly, the other pitfall I wanted to point out about EM investing on a broad basis since 2011 has been actually the China focus. And what's really odd is that, and it's not actually odd on retrospect or when you look at it, but that China economically has been a powerhouse. But when you look at equity market shareholder value creation within China, it's not proportionate to the growth, economic growth. And I think there's some disconnect there. So I guess what we're trying to say at Global X is there's a different way, an alternative way to get at emerging markets. So that next slide, please. And just to quickly itemize a few things is that you can look at Asia-oriented equities, EM or DM on a thematic basis, a regional basis, or a country-specific basis. Next slide, please. And we think that our global group thinks that India is the biggest structural long-term performance opportunity in the world. And there are several reasons there, from demography is destiny to the fact that it might have a messy democracy, but a democracy nonetheless. So the governance and government and momentum and reform is there. And I think those things are particularly important. We think that there's a digital revolution in India in terms of it does have a tech stack, one of which might be it has a universal payments infrastructure, which facilitates transactions, which is good because it brings informal elements of the economy into the formal economy, which has knock-on positive effects, meaning you can tax it as well. Another tailwind factor for India is friendshoring. So we're seeing a lot of shifting sands in international trade relationships. In consumption, we think actually that per capita income is going to double by 2028, so by the end of this decade in India, and that ought to prove helpful for that marginal propensity to consume. And really important here for me is looking at the efficiency of return that you receive from emerging markets. The fact of the matter is that emerging market investing does have some unique risk factors, and you do have to wonder whether you're being compensated with an appropriate total return against that risk that you're assuming. Otherwise, maybe developed market investing is more attractive. So everything seems to be boxes all ticked and checked for India. And the last slide, just quickly, Toby, is just looking at the degree to which the Nifty 50, which is a market cap index of the largest 50 companies on the National Stock Exchange in India, has outperformed over the past several years, continuing into 2024, the broader EM benchmark. So that's just a little bit of background. So I'll stop there and give it back to you, Nathan.
Thanks, Chad. Thanks, Monique. Look, I want to remind everybody as well, at the bottom of the screen, there is a Q&A button. Please, by all means, as we go through this, put your questions in and we will answer them all at the end. So just as things come to your mind, let's just start putting those in the queue. First of all, I think it's still worthwhile to take a step back, and especially for a lot of people who still think about EM as like this really volatile, dangerous space. I'm going to first turn to Monique, and just if you can just call out, what do you think are sort of the key differences between EM investing today than say 20 years ago, which I think is still fresh in everyone's minds?
Thanks, Nathan. Look, I think that's definitely a great starting point. Interestingly, I just looking at the performance of markets, and I will get to your question, answering the question shortly. I mean, obviously, this is a long period, but if you go back to when the emerging market indices came together by the MSCI, which was in '88, emerging markets, even after all the volatility in US dollar terms to today, has actually still outperformed developed markets. And I found that really interesting. And then if you dig a little bit deeper, there's obviously periods where emerging markets have done well over that time period. And there have been periods where developed markets have done well. And clearly the last 10 years, it's been all about developed markets. And in fact, it's actually been about the US. So it's actually been quite narrow. So when I say, Europe's obviously been a basket case for a number of years, and we can perhaps talk about that a little bit later. So I found that quite interesting. So the last 10 years has been really poor. Now, what happens is everyone kind of just takes the recent experience and kind of goes, well, QED, we just keep investing the way we did. And unfortunately, life isn't that simple. Things do change. And I remember having a similar discussion in the late 90s when I was managing an international small cap fund. And I went to an asset allocator in the asset consultant in the US. He said, well, why would we invest the last 10 years? There's been higher risk and lower returns. And you know what? The next 5 years, it was the best performing asset class. So, I think everyone has a very sort of backward looking approach to investing. And I do encourage everyone on this webinar to go, well, that's a history, but what about the future? Okay, and I think that's really important. So I think where you started off was really great, Nathan. You talked about the riskiness of emerging markets. You said, what are the differences? And I think they certainly were more volatile 20, 30 years ago. And that volatility has come around. In fact, if you look at the rolling 3-year time frame and you observe the beta of the emerging market index versus developed markets, it's actually fallen to around 0.6 now. Okay, so that's really quite interesting. And the only time when it's really expanded has been during the crisis. In fact, one crisis in particular, which was the global financial crisis.
Yeah,
I think you can't look at it from a hedging perspective. The whole question is around diversification, because in a crisis, most assets correlate to one, as we all know, and which is why investors look for tail hedges if they're really concerned. And certainly emerging market is not a tail hedge, but it is a diversifier. And so I just found the beat of the market quite interesting, because I think the perception is greater risk and the numbers are kind of telling you, well, perhaps it's not as risky. And you kind of go, well, if you think about the last 10 years, where have all the problems emanated from largely? And I mean, even if you look at it today, what are the big problem child out there? Everyone's concerned about France and Germany. Well, they're developed market economies. They're not emerging market economies. We had the Eurozone crisis in 2012 and 13. Well, that's not an emerging market crisis. That is a Euro crisis. If you look at GFC, that actually started in the US. Okay, didn't come out of the emerging markets. And in fact, during COVID, Asia was probably very strong in terms of the policies they had in place and the impact they had. They weren't throwing out the dollars and creating the huge deficit and debt problems we're seeing now during that period. I think they managed that crisis probably better in general than developed markets do. So I think that's a really important takeaway, which is, that what's probably happened is that emerging markets, in terms of it's still not there, but it's improving. Certainly places like India is a bit further along. I think that's sort of reflected to some extent in the valuations there. I think people sort of understand that. But the quality of their corporate governance framework, the economic frameworks have continued to improve. A lot of them have been running with decent surpluses. So in terms of responding to inflation, they're a lot quicker in terms of raising rates. So on the one, you could argue that there's been a lot of structural improvement in the way they're managing the economy. And at the same time, if you think about unpredictability and volatility, you can almost argue that developed markets have actually become more unpredictable, certainly from a top-down basis. So again, that's reflected in the volatility chart, which you showed a bit earlier, which I thought was an excellent chart. And that again demonstrates that the volatility has come down. And then the other,
actually, it's like picking up on that. You kind of call out a couple of interesting points, and maybe just to bring it a bit home. Do you think we should really be thinking about EM as being this sort of homogenous investment destination? And the other thing that comes to mind as well is that if we then start looking at these groups, is there anything sort of particular that separates one group from another within EM?
Right. Okay. So that's a really good question. I mean, I think the interesting thing there is when you look at it as a homogeneous group, the correlations with developed markets has continued to increase. So even though the volatility was much greater 30 years ago, the correlations between EM and DM was a lot lower, probably running at around 0.3 in the early 90s. That correlation is now increased to anywhere between 0.6 and 0.8. Depending on which market, but certainly as a group that so in fact they're much more linked together. But what's really interesting is at a country level, the correlation starts to drop again. So perhaps one thought there is perhaps just blindly throwing money at with all due respect to just an emerging market strategy and saying, well, they'll sort it out and I've got my exposure there. Well, I just found that that's what we used to do in the 90s, and guess what? This is now the 2020s, okay? So everything move on a little bit, and sometimes I find people just haven't progressed with the way the world is shifting. So I think that's one really important point. I think the second thing is there's clearly differences between each of the markets in terms of corporate governance, economic structure, demographics, etc. Right? So and all of those things have a role to play in terms of the long-term growth that's going to come through from different countries. Again, that's going to be very different. If you look at the growth rates potentially coming out of China going forward, particularly with the concerns around demographics, you only needed to look at Japan to see what impact they had on Japan. Now, there are differences between the two, so you can't just say because it happened in Japan, the same playbook is going to be occurring in China. But nevertheless, a dominant driver may be the demographics, right? So, whereas as was articulated by Chad, but if you look at India, it's got fantastic demographics, right? And I think that's one of the reasons why the US has performed so well. I wouldn't say it's the only reason, because there are multiple factors you need to consider. But demographics certainly has a key role. Vietnam is interesting as it continues to emerge. Indonesia. So with correlations at a country level being lower, perhaps looking at it as a homogeneous group going forward is not the right way to look at it. Maybe one needs to be a little bit more nuanced and thoughtful about it.
Okay, so I think that's probably the key point here is that, yeah, EM, it is an opportunity in aggregate, but also you really do need to get quite granular. I'm gonna stop you there for 1 second. There was actually an interesting question that just came through that said, can we discuss the issue of Chinese investment particularly? For the person who put that question through, would you mind just rephrasing that question a little bit more specifically? We're not quite sure what you're asking, but we'll come back to that question, and we are watching that. I'm just going to change gears now and just go flip over to Chad here. And I just want to pick up on a comment you made earlier about, is it really worth it, right? Like you kind of made that comment that China's disproportionate weight in the index doesn't actually match what it actually has given in shareholder value creation. So Chad, can you just go a little deeper into that and what your thinking is around there?
Sure, I would love to. And as a matter of fact, I think we're going to touch upon that question about what has been the issue with China. And I think maybe what they're getting at is, how could it be that they have been the world's most powerful economy in terms of growth rates year on year, decade on decade, but yet when you look at their equity markets, it's not registering the same degree of performance. So I think there's a major disconnection there. Shareholder value creation, let me start with a starting example, which is this. In 2020 during COVID, and I remember it vividly, and I know a few fund managers in Australia, in fact, were going to participate in this initial public offering. So Alibaba was going to go to market and raise capital for Ant Group. And what happened was, and I think it's going to be an issue of government and governance and so forth, what happened is that was stopped. That was put to bed by Chinese authorities. So in other words, you had what amounted to a US dollar valuation in excess of $300 billion, initial public offering being put to bed. So there is shareholder value being erased. So I think you need to be very mindful that when you're investing in EM, I would argue the most critical factor is, in fact, government, governance, and momentum and reform. I'm sure everybody on this call, when they've heard emerging market analysts speak, the emerging market analyst continually refers back to reform, reform, reform. And there's a reason for that. Because basically, emerging markets, they need to continually work their way, especially in relation to government and governance, towards structures that enshrine private property. Fundamentally, as shareholders, equity means ownership. But if you're buying into a stock and into a market that's devoid of institutionalized private property, there's going to be something that interrupts your performance. And again, I go back to what happened in 2020 with Alibaba and Ant Group. So just to put some numbers on these things, and China is a perfect example. I don't mean to pick on China. China is very interesting in the degree to which it's developed, its per capita income growth, its overall GDP growth. It's the second largest economy in the world. It's an EV player, a dominant electric vehicles player, and so on and so forth. But, on the one hand, China's economy has grown more than approximately 11-fold since 2001. which is very substantial economy, real asset, real per capita income growth. But on the other hand, China's equity market has performed very differently. So a portfolio of China's top 50 companies, and you want to look at the top 50, right? You want to see what their best of breed companies did alongside that economic growth. So the top 50 portfolio since the end of 2004 until November 2024 grew at 2.8 times. So the economy grows at 11x and the equity market grows at 2.8x. There's a mismatch there. By comparison, the US as a developed market since 2001 grew its economy by 2.5x. All the while, it saw its main equity universe, the benchmark of benchmarks, the S&P 500, grow at 8.4x. So while China's economy has powered higher since 2001, and while the equity risk of Chinese stocks, say, in terms of a simple measure of volatility, was higher than DM markets like the US, we didn't see higher economic growth and higher risk leading to investors in China receiving compensatory higher equity returns. And I think, again, that comes down to government and governance and momentum and reform. And since Xi Jinping has come into power circa 2012, 2013, we've seen a reverse course on many things. In fact, we're seeing kind of a resurfacing of state-owned enterprises. And I mentioned state-owned enterprises are problematic because they don't necessarily preference the minority shareholder. Sometimes state-owned enterprises, moreover, they're inefficient because they might give dividends because they have pensioners, but they're not reinvesting for growth. Furthermore, maybe the SOE is just growth for growth's sake without an eye toward profitability. So basically, the setup is this. Emerging markets are very interesting tools for diversification. They have very interesting growth dynamics that are different than developed markets, from demography dynamics to consumer growth dynamics and so forth. But you do have to ensure that alongside all of those factors, you're looking for milestones and signposts that there's a continuity in reform. Xi Jinping ended term limits. So for over 4 decades, China has had scheduled succession of power, and that coincided and correlated with successful economic growth and reform. And that's now ended. So there's no longer term limits. And I suspect that there's going to be a reintroduction of anachronistic political dynamics into their system. In other words, you're going to go from highly efficient, highly effective, highly technocratic working groups to perhaps intra-party faction fighting, to political capriciousness, and so forth. I think when you emerging market invest, and I remember taking this course, Development Economics, and in development economics, it wasn't just about, growth. It was about the context within which the growth occurred in terms of what is the government doing? Is it empowering shareholders and private property and so on and so forth? Or is it detracting from that? Is it continually labor market reforming? All of these things. So I'll end on that. But I think the moral of the story is you need a concurrence of all those items I mentioned on that slide with regard to India, which is a very powerful investment case. But alongside that, you need the government doing the right things. And Modi has done the right things. So since Modi has taken power, and it's his 3rd term he's going into, the magnitude of individuals who have moved into the middle class and the wealthy is astounding. It's multiples more than the Australian population itself. So that is fantastic. Modi seems to be doing the right thing. All the while, he is successfully fiscally consolidating because he's able to do that because he's bringing informal elements of the economy into the formal economy. All the while, he's still keeping his foot on capital expenditure, but with some fiscal prudence. So I think again, the stars align for us, particularly for India. And you don't have to stay stuck to just an MSCI plain EM benchmark.
Let me stop you there, Chad. I think we're gonna touch a little bit later on benchmark design, so we'll get to that in a moment. I'm just going to change gears here and just flip it back to Monik. I think there was an interesting observation that if you do sort of agree that EM is not really homogenous, can you give us some examples, perhaps, just to sort of tease that out of maybe different groups that we should be thinking about? Like, yeah, just can I put that to you?
Absolutely, yeah. No, that's I think that's certainly one of the core summaries that is starting to come through, which is it's not homogeneous. So some of the look at the highest level, some interesting differences. If you think it at the broadest level, I think Chad's gone through the India story pretty well, but it's a very strong domestic story there that continues to develop, and that's what's that's probably a significant driver there. If you go to a place like Brazil. Obviously, the big story there continues to still be around commodities. And then with China, I think, interestingly, I think the big theme there, if you take away some of the points that were raised by Chad, there's a greater shift towards self-reliance. So it's all around technology, it's all around energy, it's all around the consumer. So each country has its unique characteristics, and I think there's some broader things that are playing out, and then each country plays to each of these things very differently. So if you look at the let's call it the China +1 strategy, which is sort of outsourcing, then clearly one of the big winners is going to be Vietnam. It also happens to have a phenomenal sorry, that's probably a big word, but a really strong demographic profile. Developing very, very quickly. The middle class is growing very strongly, so there's multiple opportunities. But a strong driver behind that is around friendshoring. It's moving outside of China and perhaps looking at other areas. So if you go to China, I think technology is a big player in China. I think part of the reasons why it has underperformed is partly to do with the construct of the index. Part of it was because a lot of these capital ratings came along during a bubble type period. Does that necessarily mean that Alibaba or Tencent are bad businesses? I'm not too sure about that, to be honest with you. I think some of those businesses are actually in pretty good financial shape and actually have an excellent business model. So just to be quite broad about that can be quite dangerous. I think everyone's kind of possibly completely ignoring China to their peril. I do share a lot of the concerns that Chad has about China around corporate governance and the hand of the government. But again, that can change very quickly. I mean, China's had, arguably the strongest development of any country in the shortest period of time. Really quite remarkable. And I think one of the reasons they were able to do that is because, there's no roadblocks, there's no bureaucracy, so they can actually implement strategies and economic policies very quickly. Now, that was adverse, obviously, in the early 20s, and suddenly China became uninvestable, and we were certainly in that camp. If I look at it today, well, they can certainly change course again. I mean, do they really want to harm their technology companies when technology actually is a strategic imperative for every country, right? I mean, that's why we've got the CHIPS Act in the US. Do you think China's government is going to go and destroy its own technology sector? I think what they've done is, I think it probably was like a pendulum, things to swing too wildly. And there was no one monitoring them, and they just brought down the hard hammer. And now I think they will allow them to perform a lot better. So lots of nuances. I think the other big one, sorry, just to illustrate that from a bottom-up perspective, is the Chinese consumer has changed significantly. What we found quite interesting as a global fund manager looking at stocks and looking for the exposure to the emerging consumer is that in the old days, you could go and buy, LVMH, you can go and buy Starbucks, you can buy Nike, L'Oreal, all of these companies, Estee Lauder, which has great exposure to China, all did very, very well. Well, guess what? In the last few years, that's all changed. All of those really strong, outstanding companies with a backward-looking lens have done very well. They're not doing so well now. And that is because there's other shifts occurring. I think the Chinese consumer and consumers in other emerging economies are now going more towards local brands and away from, those global brands. So there's other nuanced shifts that are occurring. So this is where, being very kind of specific in your approach to emerging markets is going to become much more important if you want to deliver, if you want to get the returns out of the market.
And that's a really good point, Monik. And actually, there's actually a very good question that ties with that. One of the questions that we got is, are companies in developed markets with EM businesses a better way of getting exposure to EM opportunities? And I think you've answered that question elegantly by saying that, look, the big brands aren't relevant anymore. Actually, it's people are looking for local brands, and so I think that's definitively a good answer in terms of the importance of active over passive, or even perhaps even looking at factors. Which I'm going to come back now to Chad in terms of with Global X being sort of experts in factor investing. You touched on a point earlier about benchmark design. If we accept then that markets are a lot more heterogeneous, should we be thinking about new ways of indexing or new ways of cutting up the market, and perhaps not just putting China in the same bucket as Vietnam, considering how different they are in terms of their economic journey?
Sure. I think that ETFs have evolved to such an extent that, and I regularly use the phrase specificity of focus. The good thing is you can find an ETF that problem solves very particularly for what you're after. So if you want to go to India and capture some of those growth dynamics I discussed, you can do it, for instance, as we speak on the Australian Stock Exchange. You can do it on a market cap weighted basis, so purest market cap approach. You can do it on a quality style factor basis. And there's other ways of engaging in India as well. In terms of segregating out from the EM pool certain countries, you can do that as well. And increasingly, we have seen come to market. I know iShares did, for instance, in EMX China, which is, again, it's just another tool in the toolkit that you have to very surgically target what you're after. If you do have concerns about China going forward, about being in the crosshairs of something of a trade war between the US and China and who's going to win that, if you're a little bit fearful about China, where geopolitical national security concerns trump economic ones, and I think that's the case, then maybe you can reorient toward India. You can reorient toward Vietnam. Global X, our US office, actually our first ETF was over Colombia, which is very interesting. We also have an ETF over Argentina, and that one, for self-explanatory reasons, has ballooned in AUM in relation to that market. And it's good to stop just momentarily on Argentina, because you do have the right confluence of factors, particularly of reform. And that's when you start to see an acceleration of investor participation in emerging markets. I think right now, if we go back to China, I think even in spite of the stimulus, and you can see that, when the stimulus came into effect in September, the recent stimulus measures, you did see a significant spike upwards of around circa 20-25% in Chinese equities. However, since then, it's kind of gradually coming down. And so there's issues there in terms of, does the market actually confidently believe that you're going to get the right springboard for consumers in terms of the government fostering consumption? For so long, actually, the model of growth in China has been about exportation. And very fundamentally, what they're facing now, China is shifting from an export-led, a production-led, a fixed asset investment-led economy to a consumer-based economy. If you look at marginal propensities to consume in China, they looked a little bit healthy, and then they've been subtracted out, and they're deteriorating a little bit. And also, I'm a little bit worried about China, because if you look at, if you go and look at its, say, its 10-year government bond rate, they're collapsing. They're going down and down and down. So that to me seems to be, or portend to signal, perhaps. Now, I know there might be quick and sharp changes in the way in which China evolves its economy. But even that in itself, the capriciousness of it is something to be aware of. But to your point, or your question, Nathan, it's a great question. There's such a diversity of choice, not just that, Global X brings to bear, but what our peers bring to bear. They're doing great things for the ETF market, so super excited about it.
Yeah, and so let's just get into China. Actually, it is sort of like the elephant in the room. Everyone is, and you're expressing the negative view for China quite well. I'm going to go back to Monik here. I know you guys have got a different view. and you think that actually China probably is investable. What are some of your thinking around there?
Yeah, so I think structurally we certainly are the most positive in the US and India. The problem with that view, there is no problem with the view in the very, very long term, is that that's now a consensus view. And I think there comes a point, and certainly with the US, that's our concern, and is that valuations are really, really reflecting that very fully today. And I think if you look at most portfolios out there, if 5 years ago, I used to sit on some investment committees, and the asset allocators go, we need to buy Europe on valuation. We need to buy Europe on valuation. And the US continued to perform well. And I think a lot of that had to do with earnings growth. So there is still a strong case to be made that US India will continue well. However, with China, we were pretty early on. We actually sold out of our Chinese equities in 2019, starting to observe some negative developments that we're all pretty on top of now in terms of the hand of the government in corporate businesses. And I think what's happened since then is that, again, that's well and truly reflected in the very low valuations we're now seeing in Chinese equities. Now, that in itself should not be enough to buy it, because, as I said, Europe was undervalued on a valuation basis for years and years, and yet it's continued to underperform. But the problem there has been clearly the government and macroeconomic policies haven't done enough to really deliver a decent outcome. I think with China, as I sort of mentioned a little bit earlier, we've seen the policy making come through, which has been quite extreme. And I think now the heavy hand of government will slowly ease away. It's like a pendulum, as I said, and things tend to shift to extremes. China was a very exciting story. I think if we had this seminar 6-7 years ago, everybody would be espousing the benefits of investing in China, and India would have been sort of a secondary story. With the benefit of hindsight now, that has flipped. So the question going forward is, are there reasons to be positive in China? And I think there are, as I said, so the valuation is attractive. I think the heavy hand of government will start to lighten and allow these companies to actually start performing a lot better. You can find there are a lot of state-owned enterprises within the index. I would agree that just a brutal, blunt instrument like that is not the way to get exposure. I think there are individual companies there that will do very, very well. And they're exposed to some great trends. China is in terms of technology, digitally enabled technology, it's right out there, right, in terms of being digitally enabled. So that's one point. The Chinese consumer is still really critical. If you look at luxury goods, for example, today, I think they make up 23% of luxury goods sales comes from Chinese consumer. That's likely to grow to 30%. Well, that's not going backwards. They're actually becoming more important. So I think one needs to be a little bit more thoughtful in terms of being very broad and saying, well, I don't like this, I'm not going to have any exposure there.
Yeah.
And I think that's what's coming through hopefully today as well. Yes, but I think now it's about being, yes, you can buy the country exposure, and there are opportunities there. And then it's actually the next layer down, which is which specific stocks. And I think, as I said, you may end up avoiding China at your peril, in terms of potential returns going forward. I think
do you think China's done, like, clearly let's do this one, Trump versus China. Do you think that represents a existential threat to them, or is that more bluster from the Trump government?
Yeah, look, I think it's a balance of the two. Trump is obviously very domestically focused. He's a national champion, and but having said that, I don't think it's the kind of threat that you're referring to. China is a very, very important economy, not only in terms of exports, but in terms of demand for a lot of goods and services outside of China. So interestingly, they recently, Biden just came out with a whole new series of measures in the semiconductor space, but he's actually not included Holland, where ASML sits, for example, which is obviously leading players say, well, you can carry on doing what you're doing at the end of the day. So I don't think it's that extreme, Nathan. I think yes, at the margin, but I think a lot of the hard work, a lot of the negativity around that has been gradually occurring since he came in 2016, and then Biden carried on with a little bit of that policy. So I think any marginal threats are probably marginal, if that makes sense. Yeah.
Makes sense. And look, I don't want to spend too much more time on China, but I'm just going to go back to Chad one more time. I only asked this question because Global X is the largest physical gold ETF, I think in Australia and also globally. What can you tell us about what's happening with Chinese consumers and their relationship with gold?
A great question. So I think it's a reflection. What's happening with retail Chinese buying of gold this year in 2024 is a reflection of, I know on the one hand, you mentioned Chinese consumers are strong in relation to the degree to which they purchase, say, luxury items. But at the same time, it looks like they're going into gold as an alternative store of value in the context where, say, house prices aren't doing so well. Roughly 25% historically of GDP, Chinese GDP, has been in relation to property, the property sector. And that hasn't, again, been performing well. So when your primary principal store of value begins to be a non-successful store of value, you start looking for alternatives. And I think that's why they're going to gold. And moreover, interestingly enough, they're not necessarily going into renminbi accounts, cash accounts. So it looks like they're having a preference for the liquidity of gold versus the liquidity of renminbi. So I think, those are some signs about, things aren't, hot. They're kind of lukewarm for sentiment in China. And I do wonder whether, consistently, this thought comes up in my mind. I say, perhaps you can trade China, but can you invest in China? You can certainly be a hedge fund. You can move into a position. You can say buy the market when stimulus comes in. But the hedge funds aren't necessarily buy and hold holders of Chinese equities. They move very nimbly. So I just wonder how you curate and kind of carry forward a Chinese position in a portfolio on a buy and hold basis. But to your question, in addition to retail Chinese gold buying, we're also seeing buying from the PBOC, so the People's Bank of China. And I think that plays into they're looking to diversify their reserves. They're looking to diversify away from US dollar denominated assets like treasuries. And that might be a reflection of duration risk that they want to dispose of, but it could also be a reflection of the fact that, in geopolitics at the moment, we have the US taking one side of a conflict in China, more or less in effect taking the other side. So I think some of these things we have to think about in terms of where things are headed. Market growth, equity markets don't occur in a vacuum. They don't occur in isolation to other things that are moving within the global system. So I think you just have to be cognizant of what's going on in relation to EM. I think EM is a rich, textured, wonderful opportunity set. And there are multiple tools that you can get at that opportunity set, which is fantastic. But I think in particular, when you're EM investing, just be mindful of government, governance, and reform momentum.
Perfect. Look, I'm looking that there's 2 more minutes left. We've got 5 questions. There is one more thing I do want to cover on before we go to questions. And the questions we're going to do by rapid fire Q&A. But just Monik, the one thing I like to talk about is the forgotten EM. Latin America, like this is one of the larger holdings as well in the MSCI world. Within Latin America, is there anything in particular we should be looking at there?
Yeah, no, that again, I think we do forget about Latin America, and obviously the parts of Latin America that have come with an incredible amount of volatility. But look, there are a couple of economies that have continued to develop quite strongly there. You do have to look at, government and reform in any country. If there was a change in government in India, you would have had to be thoughtful about what that meant. But with Modi being there, it's been positive. So I agree with those comments that those things need to be considered. But if you look at a place like Mexico, which at the moment is obviously under just a little bit of a small grey cloud, I won't say it's a dark cloud, just because of Trump's comments around tariffs. He's obviously all guns blazing at the moment in terms of what he thinks he's going to do. But the reality is Mexico is a really important trading partner to the US, the largest trading partner. And if you start imposing major tariffs and create major problems, it's going to be potentially be very inflationary for the US. They don't have the workforce to do the amount of onshoring, without the help of some of their friends in the surrounding region, Canada and Mexico. And then when you look at Mexico in terms of GDP per capita, which is, I think, something you've got to monitor when you're investing in emerging markets, it's developing very nicely. It's actually inflected up now. So that tells you the economy is doing better. You know, it was traveling at around $10,000 per capita. It's now up at about 13,000 in a very short period of time. So it's actually operating. So, you know, these are the sort of things as an investor you need to monitor. And then when you look at the businesses in Mexico, you know, there's some really, really strong businesses, you know, strong franchises. You know, you've got to look at, you know, you've got to look at the economy. Got to look at government. You've got to look at governments. You've got to look at business models, right? We forgot about, you know, we're investing in businesses here at the end of the day. That's what makes up markets. And so there's some very good businesses there, you know, strong capital allocation. You get decent yields, etc. So, you know, I think it is forgotten. And I think that's where, you know, you need to again have a broader view beyond Asia.
All right. Hey, look, I promised to do questions. We were asking people to do it. I'm going to take 2 minutes here. These are going to be rapid fire. I'm just going to ask the question, turn to one of you guys. We're looking for like 1-sentence answers from you guys. So first one for you, Chad. Are China A companies investable, or are government policies a roadblock to any investment?
I think the jury's still out. I don't want to get ahead of myself because, you know, on our side at Global X, we do have an active team in the United States that curates Chinese equity-oriented portfolios. What they're looking for is consumption-related companies, although they are a little bit cautious about the investments that they put in China. But if they see the tides turning in certain respects, then maybe they can amplify that position. But I think the jury's still out. I'm going to say that. I know it's not much of an answer.
Okay. Monik, this one here is for you. Is the company data which underlies investing in EM companies, is it of sufficient quality?
So this is part of the bottom-up work. So that's part of the process, obviously. So the short answer is yes, you can find enough companies with good data.
Okay. This is an interesting one. This is an index question. So back to you, Chad. Is there enough? I think if I'm reading this question correctly, is there any work being done to recut indexes in EM to be more focused on fundamentals, so their revenue and profits as opposed to market cap?
Oh, that's a great question. But let me just quickly say this is market cap in relation to India, actually, because I can speak to that most accurately, given that we run a fund on India. You know, the market cap so far has been the better area to place your capital, but there are other style factor-oriented ETFs that try to target companies on a quality basis. And I think there's going to be more coming to market over the India space or maybe other EM space that look for stocks along different lines aside from how large a company they are, which is going to be exciting.
Perfect. And the last question here, I think I'll take this one. With the issues such as Korea declaring martial law today and then withdrawing it, or Adani being accused of bribery, are these markets still too uncertain? Very clearly from our speakers today, you always got to be thinking about a governance framework. Clearly, these sort of fundamental activities happens everywhere. I don't have to remind you guys about Enron, for example. These things happen all the time. Diversification is something that you use to mitigate against stock-specific risk, and of course, having great active managers. So look, I'm going to stop talking there. We're just a little bit over. I'm going to hand it back now to you, Toby.
Right. Look, Nathan, Monik, Chad, thank you so much for a really fascinating fascinating discussion today about what is a really important topic. That last question that you touched on, Nathan, which just sort of put me in mind that the front cover of this week's Economist is Javier Milei, the president of Argentina, saying my contempt for the state is infinite. Mexico facing the 25% tariffs that Monik referred to, Adani in India being threatened with bribery charges by US regulators, and then martial law. I mean, there are 4 major emerging market economies, each of which has almost a catastrophic event facing it, and yet these are the economies that are that are going to underpin global growth. So Monik, Chad, Nathan, thank you so much for a fascinating session today. Those of you who joined us, thank you for your time, and have a very good Christmas and a safe and relaxing holiday, because coming back to 2025, I suspect we're heading into an investment world which will be more confronting than those we are used to. So thanks for your time. Have a great Christmas. We'll look forward to you all joining us again in 2025.
Thanks, Toby.
Happy holidays, everyone.
Thanks, guys. Thank you.